Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Joe Downs. Joe is a lifelong entrepreneur with ventures across securities, mortgages, hospitality, and real estate. As a co-founder of Belrose Group, he focuses on niche opportunities in the self-storage sector, leading the firm's growth from acquisitions into development and consulting. Known for spotting niches within niches, Joe dives deep into lesser-known industries and eagerly shares his insight. Joe, I am looking forward to our conversation today, and thank you so much for being a guest on The Wealth Flow.
Keith, thanks for having me. I've been looking forward to this for a while. It was scheduled far out. You're a popular guy, so I'm excited to be on this podcast.
All right. Well, I'm excited as well to have you as a guest. And I like to always start with our, kind of your background, where you grew up and what led you to, real estate investing.
Oof, you want the 30-second version, the 2-hour version? Which one are you going there?
Somewhere in between. Somewhere in between. There you
go. So where did I go? So I'm an Army brat,
okay.
But spent most of my life growing up in the Philadelphia area. So I know you're in Texas. I was actually born in Texas. Born in Fort Hood.
There you go. Okay. Yeah. Killeen.
Town called Killeen. Yeah. Copper's Cove Medical Center. And in either case, we moved around a bit, but I pretty much grew up in the suburbs of Philadelphia since I was probably 7 or 8 years old. So that's where I have to say this, Keith. I'm sorry. Go Birds.
No problem.
From a big family, actually. So I was just thinking about this the other day when I was talking to somebody else. I guess I've been an entrepreneur my whole life. I just didn't realize it because it was just life, So I grew up with one of 12 kids, and you kind of learn at some point to fend for yourself. At a fairly early age, I was the 5th of 12, so. You learned, and I'm not saying, I wasn't foraging for my own food. That's not what I mean. But, you just learn you have to be independent and start to take care of little things about yourself in life at an earlier age than most, right? Because, your parents can't helicopter 12 kids, right? They can only helicopter 1 or 2 at a time. So, we had no helicopters. So, I guess that's a little bit about who I am and what maybe forged me and molded me through life. How did I get into real estate it was a series of, it was a series of reinventions. You could say, I was going to say series of failures, but I don't want to be that hard on myself. There was a failure in there, but I don't think it wasn't all my fault. So it wasn't a series of failures, but more of a series of situations where I had to reinvent myself. One that led to the kind of the big one that led to real estate was completely indirectly. So I owned a bar and restaurant. It failed. And that's a lesson I talk about a lot, in life, is why it failed and what I learned from that. And then, I was only 31 maybe at the time. So, I'm 20 years ago. I'm 51 now, but I was broke, and after that experience, and not in a great place, not mentally in a bad place, but just you'd imagine you just lost a business. You have no money, you're broke, and you're 31 and looking around, looking in the mirror, going, well, "What have you done with your life?" Right? So took a job selling radio. Believe it or not, because I needed a job. You gotta pay the bills. You gotta survive, right? I told you you gotta learn to be independent. I was independent, so gotta survive. So I took a job selling radio, talk radio in Philadelphia, which never in my wildest dreams did I think I'd be doing that, but I was, because I just had a connection, and boom, landed the job, and was paying the rent again, and feeding myself. So, but with an open mind, you never know where life will take you, because I had two clients come along while I was in radio sales, and two of these clients in particular were real estate related. So, first one was a company called Real Estate Riches, and they would advertise on the radio in Philadelphia to come to a hotel for a seminar, not a webinar. Right. We didn't have podcasts or webinars back then. This is like 2004, 2005, somewhere in there. Right. So people had to show up somewhere to a seminar, and they were teaching people how to buy, rehab, and flip single family homes. So this was my client. And I skipped an important detail of my prior history, was that I had been trying to break into real estate. I wanted to be in real estate, and two of the most successful people I knew were in real estate. I knew personally, not, had heard of. So I had been trying to break into real estate, and I didn't know how, I sit here today realizing how stupid that statement is, and not know how to get into real estate. I mean, there's so many ways to break into real estate. So the question really, if I'm being truthful with myself, is I probably wasn't trying hard enough to break into real estate, because it's not that hard, right? So anyway, the or life just, the moons weren't aligning yet. I don't know. Anyway, here they are. And this is my client, and they're teaching people how to do it. So I saved up enough money. I bought their mentorship program, and I went through that. And I'm broke though, so I don't have any money. I scraped together $5,000, which is what it costs to go through that program. And so what did anyone who's new in real estate do, has no money? Started wholesaling. All right. So I was sweat equity. I was putting in the work. So, I had my 9-to-5 job selling radio. I was, still bartending, because I was trying to make money and pay off all debts. So I got a job bartending, 1 or 2 nights a week as well. And then now on Saturday and Sunday mornings, I'm out there looking for real estate, looking for, run down, beaten down, just destroyed, cat piss smelling homes in Philadelphia, because that's the smell of money, right? And trying to remember the old taglines. And so that's what I had 3 jobs really at the same time. But that's just who I was and what I was doing. And started doing it, making a couple bucks. Got a partner. Then we started rehabbing and flipping and renting. And I'm still selling radio, and it's clipping a couple bucks here and there, right? And and then another client comes along who's a developer, and they want to advertise on the radio. There's high-end condos they're building. And I got to the sales manager, and I became very friendly. And he said, at this point, I've expressed to him I have no interest in selling radio as a career, and I'm trying to break into real estate. I probably even asked him for a job. I don't know. And he connected me with a friend of his who needed someone who's a sales guy who was either in real estate or could learn it. And this is commercial, so I don't quite fit the bill. And if possible, has a securities background, because what they're doing is selling, they're syndicating commercial multifamily office properties as syndications, but as securities for 1031 exchange clients. So there's a lot going on there. I get that, but it's commercial real estate, it's securities, and it's 1031 exchanges. before I had the bar and restaurant, what did I do? I was a financial advisor. So I check a lot of boxes. So I get the job, right? The only box I don't check is commercial real estate. But I was willing to learn, and I did. I dove in, I immersed myself, and I learned the inner workings of. At the very least, I probably really didn't know what I was talking about when I started, but at the very least, I learned how to sell and pitch deals for multifamily and office deals. And then, unfortunately, a couple years later, I have to reinvent again. Why? Because 2008 and 9 hits, right?
Yeah.
And real quick, we're in the 1031 exchange business. That's our clients. So no buyers because they can't get financing. No sellers, no exchangers, no business for Joe Downs.
Yeah, exactly.
So the writing's on the wall. We're going out of business soon. And they did. I left about maybe a year before they finally went under. I mean, they stayed around because they had properties to manage, but there was nothing else to buy and no money, coming in to buy them. So, I had to reinvent again. And that's when I met a guy at a tax lien seminar who became my partner. I went to a tax lien seminar in Philadelphia because, what's the next best thing? By the way, Keith, now I'm in real estate, right? I'm in resi, I'm in commercial. I'm not leaving, like the scene from, the Bronx Tale. And he's like, "Now you just can't leave." Like, I'm not leaving this club, this real estate club, because I love it. I was having the best time too. So I think after that, I left that company, but now I was in this kind of this small niche. So I knew all the operators. So I spent about a year trying to raise money for some other folks and just stress debt funds. Learned how to raise money for hotels. So I expanded my box of commercial real estate. But then even that, the environment was just too powerful for any of us in that space. No one wanted to invest. Nobody was moving off their cash because we were such an unknown. I don't know if you recall what you were doing in 8 and 9 and even 10. It was just,
for sure.
It was just a wild world. So I think I got a mortgage license. I was doing commercial real estate financing. I learned how to do that. I was doing whatever it took, right, to survive. And thank God my wife had a great job, pharmaceutical sales, and management actually. And so she kind of carried us for maybe a year and a half there where I didn't really have a tremendous income. But anyway, I meet this, I had Tom Dunkel at this seminar, another in-person event. And I laugh because everything's Zoom today, but back then we did it in person. He started telling me about, we didn't do anything with tax liens. Maybe we bought one. I don't remember. But he started telling me about these distressed second mortgage he bought, this reperforming, actually, I should say. And he was getting a 25% yield in this mortgage he bought in his IRA. And I really admittedly didn't know much about that or that you could even buy someone's mortgage on their house, right? And become the bank. And so I went to another seminar to learn about it. And I came home and called him and said, "We're building a business out of this." And the reason is because I had just raised $93 million of equity in 1031 exchanges at like 6.5%, 7%. I sold some deals at 6%, to the investors. And Tom was getting 25% in his IRA. 25%. I just raised $93 million at like 6.5%, 7%. There's a lot of margin there. And in the seminar, I was asking these guys, "Tom, if they sold you a 25% yield, what was their yield? 50, 100, right? It's probably ridiculous." So we started a business. 15 years later, we still have this business. We're one of the largest buyers of distressed charged-off second mortgages, residential second mortgages in the country, which is to say we're a big fish in the world's smallest pond, because it's the nichiest niches of niches, if that even makes sense. This little world of distress seconds, but even that had cycles, and it wasn't really a cycle. Actually, it does have cycles, right? There's definitely periods of more volume, of sales from the banks than less. But that had a blackout period, is a better way to say it. The CFPB, when that was created, eventually put enough pressure on banks. And this is probably roughly 2015, 16, 17, somewhere in there, where it was so onerous in the banks, the banks decided to stop selling. It just wasn't worth it. So we were building a nice business over the course of, 5-6 years. And then all of a sudden we were looking at going out of business again.
Yeah.
So time to reinvent again. And in that process, I started doing hard money lending. All right. I'm not leaving real estate.
Yeah.
Doing what it takes and doing what I know I can do, and doing, when we own someone's debt, there's a lot of crossover between that and originating debt. Right. So we had all the same tools and language and understanding. We knew what we were doing. So started hard money lending, started flipping houses again because you could. And that's one of the beautiful things about being in real estate. You can always go back and lean back on old strategies that you've used before. So during that period, and by the way, stop me at any point. I feel like I'm talking forever here, but during that period, I got an email, and the email said, "Real estate without toilets, tenants, and trash." That was the subject line. I was a good enough subject line to get me to open it, right? I was interested.
Yeah.
So I opened the email, and it wasn't the subject line for, it's not even really true, right? We need tenants, and sometimes they leave trash behind. There's no toilets, though. That part was true. But it was the body of the email. There was one line that captured my attention, and it said, 80% of all self-storage facilities are owned by mom and pop. And I was like, 80?
Yeah.
Wow. Admittedly, I don't know much at all. And by at all, probably zero, next to zero about self-storage when I'm reading this email. If you would ask me to define it for you at that time, and this might be 2016 or 2017, if you'd asked me to define it for you, I would have said, isn't it those buildings with those lots of orange garage doors? I don't know. I've never rented a unit, never been on a property. I really honestly didn't know much about it. But to me, that was self-storage. And where I live, we have, Publix everywhere. They're the orange doors. Extra Space is the green doors, which technically chartreuse. And 15 minutes up the road from where I'm sitting talking to you right now is the global headquarters for CubeSmart. So, and they're the red doors. So that's what if I knew anything, it was just, red, green, and orange. I was like, that's what I knew about self-storage. 80%? That resonated with me because of the second mortgage world I was in. It was when we got into it, and still a little bit it was the wild, wild west. It was like anything goes. Here's a second mortgage. How is this priced? You could get 10 different values from 10 different people. It was crazy. And then even how they were traded. So I knew when you get into mom and pop, you're as far from institutional. And
for sure.
When I say institutional, I mean even institutional process with anything as you can get. So to me, it said, whoa, there's got to be opportunity here. And I was right. So I bought his course. I'm a believer in education and mentorship, and I'm also the guy that'll noodle with things. I'm a curious person. So if it's not too much money, I'm a sucker. I'll buy your course and I'll see what you're about. And by the way, I'll study how you marketed it.
That's right.
The funnel I'm coming through, how that works, and then also the content of the course. Is it interesting or whatever? So I'm doing it for all those reasons, but it was fascinating to me. The more I read about self-storage, the more I became interested. And then this was from a guy named Scott Myers, who's the longest teacher of self-storage in the country. He's known for like almost 20 years. I think he's the first. And so the more I dug in and researched him about that, the more I became just so infatuated with self-storage. And then he had they call it the Academy, a 3-day seminar in person.
Right.
Came to Philadelphia. So I was out of excuses. I was going to this thing. I was going to figure it out. I was going into self-storage because I was falling in love with it. And it has been so much more interesting and so much cooler. And there's so many more niches than I ever would have thought when I first read that email and first went to his academy. It's been a pretty fun, neat industry to be a part of for 6 years now.
Yeah, no, that's incredible. Wow, what a journey. That's been interesting. I would like to so a couple things. I'd like to maybe go back to just a kind of a quick on, you mentioned when you talked about your bar and your restaurant that there were a couple.
I think you say bar and restaurant. It looks like I'm drinking a beer. This is a
right. Yeah.
drink.
all good. No judgment here, Joe. So I would love to hear about some of those stories because a lot of us have been there, right? You got a good portion of your adult working life that you've gone through, right? And all of a sudden now you're resetting and starting over, and it's humbling and all of those things, of course. But I would love to just kind of hear what some of those were, and then I've got several other questions for you as well.
So what happened with the bar and restaurant? What was that?
Yeah.
Yeah. So I was out of college. I had one job that was an interesting and also a reinvention out of that. Interesting. First job was interesting. It was a technology company. We thought we were going public because we were taking audio and visual or audio and video and transmitting it over the power line in the home. This is 1996, 97, because Wi-Fi was never going to work. Going to work. Okay. So we had a ticker symbol. We were going public, and then we were in store. We were at Best Buy. We were everywhere with these products, and then they started coming back because the company never really tested them as well as they should have. So I left that. Got a job as a financial advisor. Learned how to become a financial advisor at American Express Financial Advisors. And did that for about 7 years. At one point, switched over to Prudential Securities, and then 9/11 happened. By the way, before 9/11 happened, I was not. I wasn't in love with what I was doing anymore. It was. I lived through the .com boom, which was nothing compared to some of these other boom and bust, which nothing compared to some of the other stuff. But there was no rhyme or reason to the stock market to me. And it seemed like you had to be in the know to really make money, or you had to be really older with wisdom to understand what was going to work or not going to work. Right. And I wasn't. I had no wisdom. I was 23 years old, 24, 5, 6, 7, advising people. It's just no business being a financial advisor at that age. And I didn't love it. And then 9/11 happened, and no stolen valor here. I didn't lose a loved one in the towers or anything. But what it did was it opened my eyes to the fact that we have no control over this casino. And this isn't where I want to be. And that week, because there was nothing to do, is when I had a friend of mine who worked with me, and we belonged to the same golf club. And we played golf a lot that week because the markets were closed. And that was when we sat down and talked about, what are we doing? And that's when I said, I want to be in real estate. And so that was what led to my real estate desire, because we recognize that. So, but in the meantime, an opportunity to own a bar and restaurant, the bar that I had bartended at for the previous 9 years, because I always had the two jobs, was getting shut down because it was a Villanova bar. It became like a college bar, and too many violations. The owners were idiots, and it got shut down. And they came to me and said, "Look, we can salvage this if we reopen it as a bar and restaurant. We'll sell it to you because we can't own it." So I'm 30 and being offered the opportunity to own a bar and restaurant. Now, you're a guy. I'm a guy. What 30-year-old guy says no to that?
Right.
Somewhere along the way, this is one of your dreams. If you're a man out there listening to this and you're being honest with yourself, you probably wanted to own a bar someday at one point in your life. So how do I say no to that? So I did, and I knew, because I managed the bar before, like when I worked, I was the manager. It wasn't hard to manage the bar. That was easy. But it was just a bar. I had zero experience with a kitchen, right? So, and a restaurant, and it's very different to run bar and restaurant versus just a bar. And so one of my sayings, I do a lot of podcasts and talking, and I teach at the Self Storage Academy, and constantly when people ask me what's one mistake or one lesson you learned from, or whether you ask me or not, I offer it.
Yeah.
Is that my tagline is you have to know what's going on in your kitchen. And that's my saying for whatever your business is. There's a kitchen, there's an operations, there's a place where the sausage is made. And you, as the leader, as the CEO, whatever your role, as a leadership role is, you have to know at all times what's going on in your kitchen. Because if you don't, it's what will kill you. It'll take you out. So I didn't know. I trusted a chef to know, and he wasn't an owner. But I just thought, well, you're just like me. You're going to look after this like it's your baby. And I was wrong. He was looking after his reputation as a chef. So the food he was putting out for the little bar and restaurant, we were just a little pub. The food he was putting out was incredible. It absolutely was. He was a phenomenal chef. But at what cost? Yeah. And then on top of that, it was the food was walking out the door through the staff he was hiring, and and there was alcohol leaving the building and food leaving the building, and before I started to pay attention to what was going on in the kitchen, it was too late. So the writing was on the wall, and I just couldn't recover. So that's what happened with there.
Yeah. Makes sense. And I have several friends that have opened bars, and it always does seem like it's different when it's yours, right? Even one instance of it where I can remember, he used to be the one I'd show up and he'd give me kind of here's a free one or a free shot here or whatever it may be. And then when he owned it, he still took that same mentality. Well, pretty soon, alcohol is, walking out the door, and it's really hard to turn a profit when that's the case. So was curious about that. And then what about, so you mentioned Tom, and I know Tom, but how did you know Tom? I guess he's the one that got you into the tax lien stuff. Was this something that he was already doing?
So I didn't know Tom before that. We had a mutual friend that invited us to a tax lien seminar he was putting on.
Okay.
It was at the Pyramid Club in Philadelphia. And when it was over, and tax liens are really interesting. They're really super secure investments.
For sure.
We couldn't figure out how you could do it at scale and really make money, because the margins are a little thin. But man, if you're a retiree, or if you're have a lot of free time and you're only looking for 6, 7, 8, 9, someplace you can get 10, 11%. Pretty super secure investment.
Yeah,
but
for sure.
Not something we could build a business out of. So, but he and I started talking about other things. We lived near each other, and I don't drink anymore, but we used to I'm an Irish guy. He was kind of a German guy. And there was a bar between us. So we would go meet at that bar and hash out business ideas. And then that's where these conversations took place. Yeah.
Yeah, that's fantastic. All right. Well, no, that's quite a journey. And then, from there, you started just seeing this huge opportunity within self-storage, and just the fact that there were some big players in there, but primarily it was mom and pop operators. And like you said, I mean, when you've got mom and pop operators, you can kind of make up the terms in some respects, right? It's not precasted like it is in a lot of sectors of the market that have been around for a long time. There's kind of these standards that have come into place, and with self-storage, you had a little bit more flexibility to do some different things. So with those investments, tell me about that. I guess you went to a seminar, you learned a little bit about it. When did you do your first investment, and where was it?
Yeah. First deal, we struggled for a little while for two reasons to find a deal. One is we were not committed to it. We were still running other businesses. So our distressed debt business, which went through this lull, was back, but Tom and I don't have to do that much with it. We have one guy that runs it. So, and there's just not a lot for it. We're not allowed to talk to borrowers. So we were kind of regulated out of really having a lot of involvement with it. We buy it, we analyze it before we buy it, we price it, but then when we buy it, there's not much we can do. So we were doing other things. We partnered on a title company. We were hard money lending. We weren't, I was flipping some houses with another partner because we were still coming out of our reinventing phase. As this company was the growth of the company was halted and was almost restarted. So we were doing, and it was 2-3 year period. So we were, we had other things already happening that we were having to tend to. So we didn't put a full effort forth into storage right away. So it took us about a year to find our first deal because it was kind of a half-ass effort. But when we did find it, and we had found a third partner at that point through our storage mastermind that we belonged to. And he was actually sitting at a bar. It all comes back to a bar. He was sitting at a bar at a storage event and just struck up a conversation with a broker who had a listing that had fallen out of contract. It was kind of a pocket listing. It was in Maryland, not far from where this partner, Tim, lives. And it was just one of those smaller, it was 20-ish thousand square feet. And it was part of a portfolio that these big real estate guys who were like big industrial guys had. And this was like the redheaded stepchild of the portfolio. They're just trying to get rid of it. They weren't operating it. It was really poorly operated. And that's what we look for. It's interesting. They themselves were not a mom and pop seller the way we typically define them.
Yeah.
Because these were pretty wealthy guys, but they were mom and pop. The facility was mom and pop run. I think they had their like executive assistant managing the facility. She could care less about how the thing was managing too. It was more like, you want to move in? Great. Here's how you do it. And you want to move out? Great. See you later. They didn't really care. They weren't operating the facility. So it was essentially a mom and pop acquisition. It was everything we looked for. It was just poorly managed, rates way below market. And just, the owners asleep at the wheel. These guys just didn't care. A lot of mom and pops are differently. They're full and they just like to keep it that way. They don't want to upset the apple cart. They've got the revenue coming in and they don't really care if they're top of market. In fact, they pride themselves on not being top of the market in rate. And that's what we look for. Things like our customers love us. We're the lowest rates in town. We're 100% full. Nobody ever moves out.
Yeah.
Those are all dollar signs, dollar signs, dollar signs.
For sure.
So that's some of the things we look for in a mom and pop facility. And if I can just add to that, to something you said earlier, because you seem to be a little bit excited about the fact that 80% are mom and pop owned. That was back then.
Right.
Today, I'd say that number is, I've seen it reported differently. Low 70s, high 60s are still mom and pop. But that's when you look across, I don't even know if they're talking facilities when they say that or total square footage. It doesn't matter to me. It's irrelevant. Here's what's more important. That's the REITs / I'll add the REITs, so the three names we talked about earlier, and then I'll add to them institutional players, names you guys, if you're not in the business, you've never heard of. And they might buy a chain and never change the name. So you may have heard of the regional chain of self-storage, but it might not be owned by who you think it's owned by. They typically are only buying and playing in the 40,000 square foot and above space.
Right.
You go below 40,000 square foot, and when we look at size, if we eliminate every facility that's above 40,000, now the mom and pop ownership is like 90%.
Yeah.
Still
makes
today.
sense.
Maybe more, right? So the opportunity is tremendous out there for folks who are in their real estate progression of, I've bought the single family, kind of like I did. I started wholesaling, renting, flipping, whatever. And then I took a weird turn from there. But a lot of people, what's my next? If I remember back to my real estate riches days, it was, and then when you get to 10 cash flowing at a net $250 positive cash flow a month, then you look like that was the gold standard, right? Get to 10 and then maybe you go small multifamily from there, right? self-storage can be, and I think people are starting to realize that, can be one of those next steps, part of that next progression. Right. So that's what some people are learning. That's one of the things we teach them at the Self-Storage Academy.
Yeah, makes sense. Yeah, and that's kind of going back to your niches upon niches. You're taking the industry itself and then niching down right below where, the institutions are no longer there. It opens up a lot of opportunity for you. What are some of the things that you do teach in that academy as far as, tell me a little bit about, from a debt standpoint, what type of loans are you getting on these? I've heard because it's a business, you can do SBA. Is that even something that is worth doing in those scenarios? And, are most of the opportunities off market? Are they, things that brokers have listed? Tell me a little bit about kind of what it looks like out there on the landscape.
These are like softball questions, or at least, what a great interviewer you are, because I'm like, oh, I've got a lot to talk about on all those topics. So I'm gonna work a little backwards. So what do we teach at the academy? And actually, I'll preface it with this. We live in the most amazing time. Information's everywhere. There's everything you want to learn about self-storage, you can find on the internet through podcasts, very specific self-storage podcasts, websites, AI now. You can just get on and ask it to develop you a course if you want. What you won't get is any wisdom, right? So any know-how, coaching, mentorship. So you can learn what all the terms mean, but how do you apply them, right? That's what I don't think you're going to get with the information out. So at the academy, what we're teaching people, a number of things. One, we're showing at a high level, this is how we source, evaluate, underwrite, negotiate, and close on self-storage deals. All right. We're showing that at a high level, but we're also showing people there's an opportunity to take that a step further if you really want to get in the business, and we can coach and mentor you. Right. So and there's a fee for that. So that's what we show people at these self-storage academies. Basically, this is how it works. And if you really want to play ball, highly recommend you hire us to show you and help you. In terms of SBA and debt, Keith, this is by far the greatest time to buy self-storage, maybe in the history of self-storage. We're coming off of a really bad period in self-storage, maybe one of its worst on recorded record, like in terms of a 2-year period. We had the COVID hangover. So COVID was great for self-storage, but what COVID giveth, COVID taketh away. And the market had to adjust to that. On top of the occupancies, flying high and then rates with it and then crashing again, we had a stagnant economy and interest rates went up. So on top of like dealing with that, nobody was moving.
Yes.
We realized how tied we are to the self-storage, or self-storage realized how tied it is to the transactional real estate market, not the values. Real estate values are still up, I think, across the board nationally. And I know pockets are even, it's even higher, but I believe it's still nationally up. But the transactions, I mean, if anyone listening who's a real estate agent in title or mortgage knows it was a tough 2 years from a transactional standpoint, the last
for sure
years. You're buying now, if you're looking to buy right now, you're buying, because we buy trailing 12 numbers, you're buying bad numbers. It's been the trailing 12 are not anywhere near as good as the next 12 will be. So you're buying self-storage facilities at a discount, in my opinion. It's a local game, but if I'm generalizing, that's a fair statement. On top of that, if you're in this progression, you're thinking about getting into self-storage or buying a 10-unit, 20-unit multifamily. I'm going to use numbers just as an example. If you want to buy your next, if the next multifamily acquisition is $1 million, you would need, what's a fair LTV today right now for multifamily? 65, 70?
Yeah, somewhere in there. Yeah.
Okay, I'm not that smart, so let's use round numbers and say 70. That means you need $300,000 down plus closing costs and some working capital, right? To buy $1 million multifamily property. I don't know how many doors that is, and I don't know how long it'll take you to increase and improve the value of that. But that's what you're looking at. Self-storage, $1 million property. I can get into it with an SBA loan. And we teach and coach people to use them all the time. Why? Because in self-storage, you're not only in commercial real estate, you're in a business. And that's why we get to use the SBA loan. Whereas multifamily, office, industrial property, they are not businesses. Self-storage, hotels, those are businesses. So we get to use the SBA loans. What does that mean? For the same $1 million purchase, my students can put $100,000 down, 10% down.
Yeah.
Right? Plus closing costs, plus working capital. So roughly half the capital is needed to get into the same size acquisition, at least, deal. From there, I won't say this is 100% across the board, but I'll generalize this statement. I believe we can grow the NOI of a self-storage facility faster than you can grow it in a multifamily facility. And therefore, we can take, with less money, we can grow the asset value even faster. So I'm not knocking multifamily. I personally invest in it.
Yeah.
I have operators that I know, like, and trust, and I invest in them because I love multifamily as an investment. I love commercial real estate as investment, and real estate in general. I just personally don't want to operate them. I'm not in that business anymore. And I'm also, part of why I come on this podcast and I teach is to let people know there is an alternative option to multifamily. If you're frustrated or, it's hard to find, a good deal out there. There are other similar asset classes like self-storage.
Yeah, for sure. That's a huge difference, right? I mean, just to be able essentially you can buy 3 assets for, using that same multifamily example, 3 of those $1 million assets versus just one, just with the down payment scenario. What, one thing that I was buying a business at one point and it wasn't able to do it at the very end. There were some complications because they wanted me to be a primary. They wanted that to be my only job. And at the time, I was not willing to trade that at significantly less income than what my primary job was at that time. And this got flushed out at the very end. So it was kind of an unfortunate deal. We'd gone almost all the way to closing. Appraisals were done, everything. And it was it just came about it. Oh yeah, it was very frustrating. The lady I was,
the cost, all the money you spent to get to that point, and then.
Oh yeah, for sure. Not only that, it was everything. Yeah, that just it ended up. It was a great lesson. Learned a lot. But one thing that I did notice, there was one thing that I'm just curious how you handle this. And I don't want to go down a huge rabbit hole on it, but just out of curiosity, when I hear SBA, I think of what they did with mine, where they were tying everything on to my assets. Is there a way to limit on some of that, or just do you have to have enough assets where, the way I look at it anyway, I had a property I was going to be selling. And so I had to specifically let them know before closing that was one I was going to be selling. And they, worked with me on it and just tied everything to the other assets. But how do you handle that aspect of things where they're looking at what you own and just putting it across the board?
No 2 situations are the same. They are first underwriting the asset, and they're looking to make sure that the cash flow of the asset's going to cover the debt service. They are a little more lenient though, too. So your DSCR, they're a little more lenient year 1 than, let's say, most traditional lenders. So they might have you, and it depends on the deal. They're actually entrepreneurial about it, which is good because it's the Small Business Administration.
For sure, yeah.
But they'll look at a deal and let's say, it's super distressed. Well, they're not going to expect you to hit a 1.2 DSCR in year 1. In fact, they might only require you to make sure that your pro forma looks like you're going to do it in year 2. And it might only be 1.1 because they know you're building something. But I'm just giving you an example of how more flexible they can be than traditional lenders. For that, though, they might tie up other assets or ask for liens on other assets or life insurance, or, you pledge your primary home. But for the most part, just in general, I know this, they're underwriting the asset first. if the asset itself is more than enough to cover the debt service, they
Yeah.
don't need or want as much of your other assets or personal assets, right?
Okay.
And they have a formula. I don't know exactly what it is, but they're only asking you for what they need, not just everything to have it. They're not predatory
Okay.
lenders. They're not. There's no one there that's going back to their boss like in a private sort of institution and say, I tied them up this way and this way and this way and this way and this way.
Yeah, exactly.
And then the last 5 ways weren't even necessary, right? That's not what you're looking at. It's whatever their formula is, they're making sure they're covered and no more than that.
Okay.
But a lot of times, because we're using the SBA, just think about the typical borrower who is using the SBA. They may not have a ton of other assets. So we might have to tie up our personal house.
Right.
As a major asset. So, until one day, then we don't have to. So it has its advantages. If you consider that a significant disadvantage, it is what it is, and that's you're not forced to use the SBA. It's just an option that helps a lot of people get into commercial real estate, and then you grow from there. A lot of people grow out of it or away from it. Others stay with it. You know why? Because they'll buy one facility using an SBA loan, and a year later, the SBA allows them to do 100% financing on another facility.
Yeah.
Same
Oh, wow.
operation.
Okay.
So now you're no money down. Now how much are you crying about the other assets you tied up?
Right.
Because they would be tied up by your next one anyway.
Yeah.
So it's called, it's a, I don't know what to say, it's cost or price or whatever. It's just part of doing business if you're going to use the SBA. But don't think there's no vindictive predatory lending practice there. It's just the formula they have, and they need to be.
Oh, for sure.
They also have the lowest default rate of any lender in history. So there's a reason for it.
Yeah, yeah. No, it makes total sense, and I could see why on the looking back at that particular business as well. If looking at the trailing 12, I mean, there were reasons why they were tying up stuff. I just didn't know exactly how that worked, and but I've always been curious.
And whether you were the manager, I know nothing about this situation, but it might have come down to either you must have had experience in the space, whatever you were buying, and they wanted your experience, or and I'm surprised you guys didn't flesh this out. And maybe the deal doesn't allow for it. Or you can bring in a third-party manager as long as they're approved. But they want to make sure that whoever's in charge knows what they're doing, right?
Yeah.
So either an approved third party or you who has a resume with experience, or a partner with a resume with experience.
Yeah, and it wasn't the SBA that required it. It was part of the franchise. Yeah, so they wanted you to be a primary. Even though I knew other cases, I knew friends. One of the guys I consulted with doesn't manage his, but I guess initially he did, and so that. And I was buying it through. Yeah, it just. Well, this is about your deal, but yeah, it was kind of like at the very end. I found
now I want to find out about.
No, I know, no, for sure. Yeah, no, it was an interesting deal at the very end.
Let me ask you a question, and then we'll move on. Are you looking back? Are you happy that you didn't do that deal?
Yeah, I am. It's one of those where I think I would have been just spread way too thin.
And stuck in a franchise, maybe.
Exactly. Yeah. So for sure. But yeah, these are all lessons, and sometimes there's a cost of doing business. It's just the tuition of the lessons learned, and that was certainly one of those. So, well, this has been interesting, Joe. I want to be respectful of your time. How can people find out more about you if they want to learn more about investing with you, and tell people how they can find out more.
Best way to reach me is just my email, joe@belroseam.com. That's BELROSE, A as an asset, M as in management.com. Shoot me an email. Happy to either connect you. If you're interested in learning how to buy self-storage, we'll get you an invite to an academy. If you just have questions about it, I'm happy to, either jump on a call or just, trade emails, whatever works.
Perfect. And I've got just a couple more questions I ask every guest, and we'll have to do this again. I know we didn't quite get to everything. I'm sure that we wanted to talk to, so we'll have to find another time to get together on this. How about any advice you would give somebody who's maybe just starting out in their investment journey?
Investment journey?
Yes.
Yeah, keep listening to these podcasts. We didn't have them, 20, 30 years ago. I wish I did. Podcasts, books. I can recommend some books. But if you're, I'm answering this from the standpoint of someone's making maybe more of a passive investment. But if that's the point of the question, then podcasts, get to know, if you're looking at a passive investment, I once had an ebook we used to circulate called The Safe Method, and it's SAFE. So, real quick was what it was, is you have to know the sponsor, do a ton of research on the sponsor, because nothing after that, if they don't check out, nothing else matters. So you got to know the sponsor. A is for asset. What is the asset? Get to know it, do research on it. You got ChatGPT now. It's even easier to do research on these things. F is their financials. What do the financials look like? Stress test it, have them stress test it for you. Not just don't be concerned about what's the pie they're selling you, the 18, the 20, the 25 IRR, whatever it is. What's the downside? What's the realistic? What's when things don't look good? Things don't go well. When are we going to make that? And then E is the exit. How are we getting out of this thing? What's your plan? Is it a 5-year plan, 3-year plan? What if COVID-2 comes around? How are you getting out of it then? That's a bad example because that's hopefully once in a lifetime. But, interest rates spike. How do you get out of this investment then? What's a normal stress test for, and what's your exit plan if something goes wrong?
Yeah, no, that's a great, I think that's a great example. And I think just in hearing your story as well, if it's somebody that is more hands-on, it sounds like you were a guy that did quite a bit of, whether it be masterminds, whether it be, joining, seminars, going to seminars, finding out how do you put your hands on, whether it be wholesaling, all that good stuff, right?
Yeah, if you're going to get your hands dirty, get a mentor and coach.
Yeah, exactly.
I tell people all the time, whatever it costs, you will make up in your first deal, either in profit or in not doing a deal, or in even, we save students. I don't know what the average is, but I'll bet you we save on average students just in the purchase price, negotiating the purchase price of a self-storage facility. I promise you we save them more than they even cost for the mentorship program.
Oh yeah.
Forget about all the deals we talk them out of and all the profit we'll help them make. Just in the purchase price, I guarantee you we save them more on average than they pay for the course.
For sure. I don't doubt that.
Yeah,
and then how about a book recommendation? That doesn't have to be real estate related. It certainly can be. Something you've read, though, that's been impactful.
The two most, can I give two? The two most impactful books I've read recently still, and it's been a while for me since I've read it, is Who Not How.
Mm-hmm. Yep,
by Dan Sullivan and James Hardy. And I've probably read it 3 times because you have to go back and reread it again because there's so many good principles that you forget and get away from. And the other is The Road Less Stupid by Keith Cunningham.
Yeah, that one's been coming up quite a bit on this one.
It's a phenomenal book. And probably one I need to read again.
Yeah, me too. I said that before. We heard him at an event one time, and it's been a while since I've got to jump on that one again. Well, Joe, this has been awesome. Glad we finally got connected here, and I appreciate you being on the Wealth Flow. I think we'll call it a show.
Keith, thanks so much for having me. Appreciate it.
Yeah, thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.